A lot of people know how to invest in bonds and GICs, but thought about investing in private debt for real estate, mortgages. That's the sort of thing that a lot of people don't think about when they try to get interest income. It has risks, it has limitations, but it also has some upside. We're going to talk to an expert about that this week, and we're going to see whether or not private real estate debt is the sort of thing that you might want to consider as you make better wealth decisions. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. This week, we're speaking with Spencer Hurley. He started off at Manulife, where he discovered his passion for alternatives and their ability to help clients in their investments to do things that they couldn't otherwise access. And now he works at Trez Capital. He specializes in commercial real estate development and focusing on both debt and equity strategies across open and closed-end products. How are you today, Spencer?
I'm doing well, John. Thanks for having me.
Glad to have you here. This is a conversation that I've been looking to have for some time because the asset class has been somewhat controversial and you're a great person to talk to about it. So let's get right into it. In fact, before we get into real estate, let's begin with a very high level question. Private real estate is sometimes called an alternative asset. And could you maybe take a moment to walk us through what you believe is a fair definition of alternative assets and alternatives in general?
Yeah, for sure. So alternative, you kind of hit the nail on the head there. It is a very broad term that, the actual definition is anything that doesn't fall into the conventional investment category. So stocks, bonds, and cash. And so that list, is essentially endless. It's real estate, it's private credit, it's private equity, it's hedge funds, it's derivatives, it's venture capital, it's arts and antiques, it's gold. And so that list can essentially go on. When it comes to the asset class itself, it was historically very much used for the ultra high net worth or the institutional client. And those tend to have, a longer time horizon. They need less liquidity, but we've seen recently a big democratization of the asset class, and it's becoming more widely spread throughout the retail channel and just your everyday investor. And so that has led to, structural changes with the way that a lot of these alternative funds are managed. We saw a big change in that in the US, and that means changing from the closed end side, which, I mentioned the institutional and ultra high net worth just need less liquidity. And so a closed end will lock you in for 5 years and there's no way to get your money out of it essentially. And we've seen a switch in that structure to more of an evergreen and open-ended structure. And so the barriers to entry into the asset class have really decreased over the years.
Right. And the barriers to entry, oftentimes we now have these evergreen products where you can usually get out in about 90 days. And so it's not as liquid as T+1, like it would be for a stock or bond or mutual fund or ETF, but it's also not closed end and locked up for years at a time either. It's somewhere in between. And one of the things that I find when you talk about democratization, which is a word that I like as well, is that a lot of ordinary retail investors are now finding that they actually can invest in alternatives in a way that perhaps might not have been available even 5 or 10 years ago. It's become a lot more accessible to most people. So that's wonderful. So for the listeners that are unfamiliar with real estate debt, how would you describe real estate debt as an asset class, and maybe how does it differ for equity?
Yeah. So the term real estate debt is self-explanatory. It's lending on real estate. And I think we've all experienced that traditional type lending at some point, whether it's, car financing or, mortgage, and many of us are in mortgages at the moment. And so that traditional style of lending is more long-term. It's lower interest rates. And if you were to invest in that asset class, it's lower returns, but it's, as I said, longer term. On the private side of the real estate lending, and this usually operates in many areas that banks either don't participate in or are too slow to participate in. And that's a key to the, development lending side. And, or banks, they often work in a box. And so many developments are, they're often different and they require a little bit of customization. And so it's for the business that we're in, it's lending on development. And so the private lending side is short term. In our sense, it's always short term. It generally comes with higher interest rates. And someone once told me that to not look at what we do as expensive debt, but instead to look at it as cheap equity. And so we're a necessary part of the development landscape in order for them to get their exit financing from that long-term traditional side of it. But ultimately it is lending on real estate. You have a physical asset of collateral in there, which is your safety net on the debt side. Now, when it comes to how it differs from equity, it's the debt side doesn't actually own anything, whereas the equity side does. And so when it comes to, there's a lot of sides to it, the tax side and, the upkeep and all of those costs that obviously falls on the equity. But if you look at it purely from an investing standpoint, I'll give you an example. You have an asset that's worth $100,000 and you have $75,000 of debt on that. That would mean there's $25,000 of equity that's put in. If the valuation goes up and all of a sudden it's worth $150,000, congratulations, equity, you've made $150,000. The debt side stays the same. You don't participate in that upside. Now, on the other side of it, if the valuation goes from 100 to 75, the debt is wiped to zero and the equity is still the equity is wiped to zero and the debt is still at 75. And so the debt side doesn't own anything, but it does have the physical collateral and they are paid out first. So if you look at the capital stack, you would have to pay off the complete debt before equity can take any other money out of it.
Okay. And that's sort of investing 101. And pretty much anyone who owns a home will have a pretty good sense of the equity they have in their home and the debt being the mortgage that's still outstanding. So that's just another way of finding a way to invest in things. In this case, you're just investing in someone else's real estate, not where you actually hang your hat at the end of the day, but you can still invest in real estate in other parts of the world. And you can get diversification and obviously all the things that you normally look for in an investment portfolio. Let's talk about the headlines. We've gotten a lot of headlines in the past little while about private credit, and maybe we can talk about how that fits in the ecosystem relative to other things that you might hear about. What can you say about that?
Yeah. When I look at private credit and I compare it to what we do on the private real estate lending side, the key thing that I look at is collateral. Collateral is ultimately what your safety net is, what you take over if something goes wrong. And, you can do all the due diligence in the world. Sometimes things don't go exactly as planned. And so if something goes wrong, what is your safety net? What's your collateral? What we've seen from private credit mostly coming into the market is lending to mid-market businesses. It's not pigeonholed to mid-market businesses, but that's really a lot of what we've seen coming into our industry over the past couple of years. And so if you're lending to a company, sometimes the collateral is good, sometimes it's not. But if a business goes bad and they can't pay their loans, how can you get your money out of it? You have to take over that business. You sometimes have the inventory as your collateral that you'll have to sell. And so there's a lot more hurdles. And to me, there's a lot of question marks on what the desirability and what the transferability is of that collateral. When it comes to the real estate market, you always have a physical asset of collateral. And, the real estate market goes up and down, but ultimately you have something physical there that you can take and sell and get some of your money back or all of your money back in a hopeful situation, which, back to our last conversation, the equity would have to go to zero before that debt side loses $1. When it comes to the headlines, there's just been such a big buzz around private credit recently. And I don't want to paint the whole thing with one big brush because I'm not saying anything negative about the asset class, but there is a lot of money chasing not as many deals. And so you just have to pick your managers correctly when it comes to that asset. Really when it comes to any asset, but not all private credit is going to be created equal would be, I think, my ultimate headline.
And the thing that I would add is that when you're buying a basket of mortgages, essentially, it's another way of diversifying. You're buying multiple buildings in multiple parts of the world. It's not just in one market, so that there are different real estate markets. The situation in Toronto is different from the situation in Houston, is different from the situation in Red Deer. And so as you go through things, you get a chance to diversify by geography. I suppose you could say by currency, but also by the type of building, by where you're at, the age of the building, all of those things. And so, yeah, it's a great way to actually spread the risk, and not being people who buy simply one apartment building, for instance. Many of them do very, very well, but it's one building. And if something happens, if it's a single industry town, think of Sault Ste. Marie. We now have a situation where there's been a massive layoff there because of the tariffs. If you have a building in Sault Ste. Marie, it can be very profitable for decades at a time, and then suddenly vacancy hits 50% because the cash flow dries up because people have to leave town because they've lost their job.
Yeah, it's very true. You can take that even further and say, there's multifamily, there's single family, there's office, there's industrial, there's retail. And so, we saw very obviously COVID when all of a sudden offices were, no one was going into the office, and people didn't think anyone was going to go back into the office. Now that's shifting and people are going back to work, but yeah, that's a very good point. You can diversify within the asset class there.
So let's talk about interest rates. When a lot of people who invest for income will buy bonds or GICs, and a lot of people don't really think about, well, what if I bought a basket of mortgages and used that? What can you tell me about the interest rate environment, the pros and cons of holding a basket of mortgages relative to buying a more conventional product that you can maybe buy and sell the next day?
Yeah. So when it comes to the basket of mortgages, I mean, the way that we lend is floating rate with a floor. And so when the mortgage or the loan goes into place, you've got kind of your bottom, and then as rates go up, you do benefit from the upside, but it only can go down to a certain point. And so you do have a band in which we would operate in. There's only so high that you can lend before it really stresses out the portfolio, and there's only kind of so low that you can lend before people are, you just have way too much building, and it doesn't make sense in there. So there's kind of a band in there with 100 and 150 basis points that you stay within. We've seen such an interesting environment over the past 5 years when it comes to real estate and when it comes to interest rates, because I mean, we saw the 0% interest rate environment, which impacted everything. I mean, let's start from just single family homes. All of a sudden, everyone has more buying power. Your mortgages are lower. And you have more money to spend. Here in Ontario, we saw houses just flying off the shelves. They couldn't stay in the market, right? And then even looking at the multifamily side, all of a sudden the REITs and private equity, you see the valuations of those go up because they're buying more because they could charge less rent to make the numbers make sense. And then even on the development side, when a 0% interest rate environment, all of a sudden every development makes sense and every development pencils, and that caused a huge boom in home building. And so once we saw those interest rates go up, we've turned the cycle where all of a sudden we're seeing less houses move on the traditional market because your buying power is less. And then when it comes to the multifamily side, this overbuilding that came in from that 0% interest rate environment all came to the market at the same time. And so we're experiencing right now in a lot of areas an oversupply of housing. You mentioned Toronto and Vancouver condos, which is a prime example of what we've seen on the oversupply of the multifamily. Similar things. So we operate a lot in the Sunbelt states of the US, and we've seen a very similar experience where just all of that housing came to the market in 2025, which then caused rents to come down and valuations to come down. And so we've seen a bit of a freeze within that market on the multifamily side of the US. Now, the housing, once again, going back to the development side, as rates shot up from 22 to 23 there, we saw the housing starts fall off a cliff, both in Canada and the US, and they've kind of sat in that spot. And so as we progress through where we are in the cycle, the expectation is that we will get to the point where nothing's coming to the market anymore. and all of a sudden that excess building is gone and we go back into an undersupply situation. So the interest rates, to your question, and how they impact it are very important, and really it has a lot more to do with how big of a swing that we've seen as to why we've seen such extremes in the market over the past couple of years.
Okay, so let's talk about investing for a regular income stream in general. And I'm wondering if we can compare and contrast using private debt in real estate to traditional bonds and GICs. And could you maybe compare and contrast the two, but in particular, draw some attention to the real risks that might be associated with in using private real estate as well?
I believe there's two main risks to the asset class that we operate in. The traditional side, you have a lot of safety. I mean, GICs are one of the few things out there that have the term guarantee in there. And so that is a very nice, friendly term, but you will just get a lower return on it. Same thing with the traditional bond market. You will have up years, down years, but once you see interest rates, go in either direction, it massively impacts to the point where you can see losses in that situation, as we've seen over the past couple of years. And in that extremely high interest rate environment, we saw bonds down significantly throughout that period. When it comes to the risks of the private real estate asset class, I think there's two main risks. One of them is manager risk. I've always believed that manager risk can be removed through diligence. You want to make sure that you have a manager that's been through market cycles, that is not over lending on one specific project or to one specific, or to your point of diversification before, that comes in many different flavors. You want to make sure that they're using third-party valuators, that they're evaluated correctly. There's no conflict of interest. And there's a lot of steps to that diligence, which I know you and your team, John, have always been very good at. There's aspects within that risk that can change market cycles and things that people don't control. But if you have the manager that you trust is going to do what's best for you and your clients and always be focused on capital preservation and getting through that, then it does remove a lot of that manager risk. Other side of it, and this is something that's very different from more of the traditional asset classes, is liquidity risk. Liquidity risk is a big one when it comes to just the alternative asset class in general. I think that, there's one side of it which comes from, there's a bit of a mismatch, especially with the democratization that we've spoken about before, changing from that closed end to that open-ended structure, giving people that 60, 90-day liquidity does not really match up to a real estate development project, for example. And so you're creating a liquidity option for people that isn't really there. And in most good times, you have money flowing in from loans that pay off and from all kinds of different places, and you can make that liquidity work in order to, make it a better option for the retail client. But in some situations, if a lot of people are trying to redeem at the same time, it's more likely that no one can redeem. And you run into that situation where it becomes illiquid for a period of time. And so the other side of it would be coming through a market cycle. And in the current cycle that we're in, if you have a lot of valuations that have come down because of XYZ reasons, which we've kind of touched on before, but all of a sudden a manager may decide that it is better for the funds, it's better for their investors to pause the redemption side of things so that you can fix kind of that back end problem and come back stronger and have people actually getting what they were invested in the projects for. And so when it comes to liquidity, it's key to look at any alternative and say, I don't want to have this as my cash sleeve. It's not something I look at trading in and out. It's a long-term investment, and ultimately not over allocating. If you have too much allocating to one specific fund, you may run into a situation where it becomes illiquid for a period of time. And if you need that money, it doesn't work well for you in that situation. And so those are the two main risks to watch out for. One of them can be removed, as I said, through diligence, and the other one just is about proper allocation and not needing that money for the trading and cash side of things.
Okay, so That's fair. And risk and return are related. When there are these additional risks associated with the asset class, you should probably expect the return to be at least somewhat more favorable as well. And again, let's not talk about any given year over a market cycle, over 5 or 10 or whatever years. What's the delta? What's the difference in terms of what a reasonable return might be for bonds or GICs, and how much more would you expect to get roughly using private real estate?
I mean, once again, it changes depending on the cycle, and it's not necessarily just about that ultimate alpha that comes out of it. Really, people look at the alternative asset class, and there's kind of three aspects to it. There's diversification, there's stability, and then there's high octane. And so some of them will provide one, some of them will provide a mix of both. In what we do on the private real estate debt side, it's about consistency and stability. So it's
The low end.
no down periods, essentially, of that stable side of it. And then, you get a little bit of a buffer from the GIC or the GIC rate or what's going on in the fixed income market. So we have a couple different funds and they vary on risk and level, but you're looking at 4 to 5% when it comes to the risk-free rate to get to our US fund is a historical kind of spread that you'll see. When rates jump up very quickly, the spread tightened, but as rates come down, it does spread out again for us. So we're kind of in that spread out period at the moment.
So here we are now. Let's talk about 2026. I don't usually have guests talk about pulling out their crystal ball and offering a prognosis, but I think with you, given that the asset class has been fairly actively talked about in 2025, wondering if you could offer your thoughts as to what we might reasonably expect over the next year or so.
Yeah, I mean, it's funny to say crystal ball because that's exactly how I would open this question and say I don't have a crystal ball, and I can't. All we can really do is look at current data, look at current macroeconomic conditions, and then make an assessment based on that information. And so, if we kind of look at where we are in the cycle, I'm going to break this down Canada and then the US because they are very different. If we look at expectations on rates, which, we've expressed are important to what we do and how it impacts the market, I think Canada, based on what we're looking at, may have a pause on rate cuts, and we may see rates stay where they are, whereas the US may have a couple rate cuts coming into next year. The Canada outlook is very regional. So, once again, we talked about Toronto and Vancouver, and that's going to have a very different outcome than Calgary and Saskatoon, for example. What we've seen if we talk about Toronto and Vancouver, the foreign buyers are gone. We've removed them from the equation, and we've seen a big change in immigration. And so one of the stats that I saw recently was that population in Canada fell by roughly 76,000 people over the third quarter of this year. And that's the largest decline that we've seen in Canadian population dating back to 1940.
Okay.
And so that, when we look at the oversupply of condos in Toronto and Vancouver, combined with affordability, it just leads us to a little bit of uncertainty about the Canadian market in general. And we can go down a big rabbit hole on that. But right now, we are not currently lending, period, given our liquidity situation. But I don't think that we would be lending in Canada. We do think it's going to take a little bit of time to come out of this. Ultimately, there is a demand for housing, and in many areas, we do have an undersupply of housing. So once again, it's very regional. But right now, we'd say it's going to be 12 to 18 months before we start to see that market turn around.
All right.
On the US side of things, we had that overbuild that happened in that 0% interest rate environment, and we are slowly coming through that. And so we are expecting within the next 12 to 18 months, the absorptions are going to outweigh the supply that's coming into the market. So especially in those Sunbelt areas, we're still seeing the population and job growth that's coming in through those states. Once again, it is regionally market specific, but in differing times, you will see that absorption outweigh the supply that's coming onto the market. And so our outlook for specifically the Sun Belt of the US within the next 12 to 18 months is where we do start to see an undersupply of housing again throughout those markets. And so we expect that to pick up a little bit faster.
Okay, so I like to end up with the question that I ask everyone, and that is, the podcast is called Make Better Wealth Decisions. If it was up to you, Spencer, what counsel would you give to the listeners about making better wealth decisions?
I think for me, it's about staying invested and staying the course. And that's always been my thought process. It's so easy at any time to panic. There are so many headlines and there are so much noise out there. And in my experience, I've seen people just pull out because they're scared, and they're either pulling out at the absolute worst time and, they miss out on the up, or they've lost a bunch of money because they've exited and moved to cash. So to me, it's stay the course. I wouldn't say ignore the headlines, but there's a lot of noise, and utilize someone like John here to sit through the noise and help you stay the course.
Thanks very much for your time today, Spencer. It's been a real pleasure, and I want to wish you all the best in 2026.
Thanks, Jack. You as well.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.